2025 has been one heck of a ride for crypto investors. Bitcoin just hit fresh new all-time highs. Ethereum has rebounded after months in the doldrums, and institutions are diving deeper into crypto than ever before. But with the macro backdrop shifting and regulatory clarity finally emerging, what's next for crypto? Today, we'll break down a brand new crypto report to find the answers. My name is Lewis, and unlike your nephew's 5th birthday party, this video is not to be missed. The report we'll be summarizing for you today is titled, quote, Charting Crypto, and it covers Q2 of 2025. It was co-authored by Coinbase, which needs no introduction, and Glassnode, a leading on-chain analytics company. As always, we'll leave a link to the full report in the description below, but we'll be giving you the highlights here in this video. The report kicks off with some key market insights from the authors themselves. According to them, crypto markets have found their lows earlier this year and recovered faster than most expected. Despite tensions around tariffs earlier in 2025, Bitcoin managed to hit new all-time highs in May and again in July, driven by an improved U.S. economic growth outlook, anticipated Federal Reserve rate cuts, and regulatory progress around crypto in the U.S. Notably, the authors highlight the trend of corporations purchasing crypto, primarily BTC, for their corporate treasuries, as a significant new source of demand. While the authors acknowledge potential systemic risks linked to leveraged crypto buying by companies, they're confident that Bitcoin's trajectory remains positive in the short term. But they do expect only select altcoins to benefit from this positive momentum. Now, the report then moves on to insights from some of the brightest minds in crypto, because, as the saying goes, it's always good to know where the smart money is heading. Kicking things off is Bitwise Asset Management. According to their head of research, Ryan Rasmussen, U.S. spot Bitcoin ETPs have purchased 225% of all newly mined Bitcoin since January of 2024. In other words, they've purchased more than double the amount of BTC that's been mined over the last 18 months. This relentless appetite for BTC from corporations and institutions means its already limited supply is getting even scarcer. As Bitwise simply puts it, quote, the outcome from here is simple economics. In other words, growing demand against a backdrop of scarce supply. All else being equal, price will rise, and that's basically what we've seen. Next up is Grayscale, whose researchers are keeping their eyes firmly on the AI crypto sector. Their chart highlights something pretty fascinating. The combined market cap of over 20 institutional-grade crypto projects building decentralized AI sits at just $15 billion, which is less than 1% of Bitcoin's total market cap. That's astonishingly small considering how much buzz we've seen around artificial intelligence. So, needless to say, the AI crypto niche might be worth keeping an eye on. Next, we have Parify, a crypto-focused investment firm who's turned their attention to decentralized prediction markets, specifically Polymarket. According to Parify, Polymarket has experienced something of a watershed moment following the turbulent 2024 US election. In fact, during April and May alone, Polymarket clocked over 15 million website visits, a sign that retail investors are increasingly flocking to prediction markets to gauge real-time sentiment and even outcomes. Although betting markets might seem niche to some, their impressive growth, even after the frenzy around US presidential elections, points to increasing mainstream appetite for decentralized alternatives, something that could spill over positively to the broader DeFi ecosystem. And by the way, if you're enjoying these juicy insights and want to stay ahead of the curve, then go ahead and smash that like button, hit subscribe, and don't forget to ding that notification bell so that you won't miss out on the next upload. Now, the next part of the report provides a general overview of the crypto market, starting with Bitcoin dominance. According to the authors, Bitcoin dominance rose to 64% in Q2, its highest level since early 2021. The reason for this rise is likely due to the fact that investors have largely been rotating away from riskier altcoins and into BTC as a safe haven amid ongoing macro uncertainty. Interestingly, Ethereum and Solana's shares of total market cap have simultaneously edged up slightly, suggesting that investors are still gravitating towards so-called blue chips. And if you're wondering which of these two blue chip cryptos have the biggest potential, then we've got a handy comparison video breaking them down right over here. Anyways, the report then examines perpetual futures funding rates for BTC, ETH, and SOL, which fell sharply during Q2 amid volatility triggered by Trump's tariff saga, reflecting reduced bullish sentiment among leveraged traders. In other words, while investors were previously piling into leveraged positions, either long or short, market sentiment has become far more balanced and rational in recent months. That's a solid base for higher highs, as we've seen. Next, the report looks at weekly inflows into US-based spot ETFs for Bitcoin and Ethereum. According to the report, combined net inflows into BTC and ETH ETFs hit a massive $14.6 billion in Q2. That's a big old jump compared to the relatively modest $627 million of inflows that we saw in Q1. For context, weekly inflows into Bitcoin ETFs alone continued their steady climb, hitting all-time highs in cumulative balances. Meanwhile, Ethereum ETFs, which struggled earlier this year, saw an impressive turnaround, attracting $1.7 billion in inflows during the quarter. Digging deeper into these ETF balances, it's clear that BlackRock still leads the pack when it comes to Bitcoin holdings through its IBIT fund, maintaining a sizable dominance over other ETF providers. On the Ethereum side, BlackRock's ETH A fund and Grayscale's ETH E fund remain neck and neck as the largest Ethereum ETF holders. Additionally, the report includes an interesting comparison of Bitcoin and Ethereum's current price performances relative to their past market cycles. For Bitcoin, after closely mirroring the 2015 to 2018 price cycle for about 2 years, the current cycle, beginning in 2022, began to diverge slightly in early 2025, as some long-term holders reduced their risk exposure. Nevertheless, BTC's trajectory remains bullish, closely following previous cycle patterns. Ethereum, meanwhile, showed a significant divergence from its previous 2018 to 2022 cycle, entering a sharp decline earlier this year. However, the report highlights that ETH saw a notable rebound in May due to a surge in short covering and technical repositioning among traders, driving its most recent recovery. Moving on, stablecoins have continued their meteoric rise. Total stablecoin supply hit a record high of over $230 billion, while monthly stablecoin transaction volumes exceeded $4 trillion. The report emphasizes how recent U.S. legislative moves towards stablecoin regulation are providing much-needed confidence to institutional players, which could pave the way for even greater adoption. And finally, the report looks at correlations between crypto and traditional assets. Interestingly, Bitcoin's correlation with the S&P 500 increased from 0.4 to 0.55, meaning BTC is still somewhat positively correlated with equities. For context, 1 would be a perfect correlation. However, Bitcoin, and crypto in general, maintains very low or even negative correlations with other traditional assets like gold at roughly negative 0.09. And as you already know, low correlations are exactly what institutional investors are looking for when adding assets to their portfolios. Oh, and before I forget, if you're looking to maximize your gains during this bull run, then don't forget to check out the Coin Bureau deals page. That's where you'll find sign-up bonuses of up to $100,000, trading fee discounts of up to 50%, and cash backs on deposits of up to 75% on the best crypto exchanges around. Now, these deals won't be around for long though, so take advantage of them ASAP using the link down below or this QR code right over here. Okay, so the next part of the report takes a more in-depth look at the star of the show, Bitcoin. According to the authors, Bitcoin is once again flexing its muscles, outperforming traditional assets on a risk-adjusted basis, especially as U.S. fiscal developments bolster its narrative as a store of value. The authors start by looking at investor sentiment using an on-chain indicator called Entity Adjusted Net Unrealized Profit and Loss, or NUPL for short. NUPL basically tells us how bullish or bearish investors are feeling based on whether they're sitting on unrealized profits or losses. According to the authors, Bitcoin sentiment substantially improved during Q2, moving from anxiety in the first quarter to belief. This is significant as it aligns with improving macroeconomic conditions and the easing of trade tensions. Simply put, investors are feeling a lot more optimistic about Bitcoin's future. And speaking of optimism, the report highlights an eye-opening metric about Bitcoin's supply profitability state. In Q1, less than 75% of BTC holders were actually in profit. But by the end of Q2, this figure has surged all the way almost up to 100%. To put this another way, at the start of Q2, around 4 million BTC coins were underwater, meaning their last transaction price was above the market price. But at the quarter's end, this number had dropped to nearly zero. It's an astonishing turnaround that underscores just how quickly fortunes can shift in the crypto market. Next, the report zooms in on BTC's liquid and illiquid supply. For those unfamiliar, liquid BTC refers to coins moved within the past 3 months, whereas illiquid BTC refers to coins unmoved in more than a year. Notably, Bitcoin's liquid supply rose by 12% during Q2, while its illiquid supply dropped by 2%. What this means is that some long-term holders took advantage of Bitcoin's recent rally to take profits, handing off their BTC to newer market participants. Yet the modest decline in illiquid supply indicates that most holders are still holding strong. The report then looks at Bitcoin's realized price and market value to realized value ratio, or MVRV. For those unfamiliar, the realized price is the average price investors actually paid for their coins, while MVRV measures how far BTC's current price deviates from this realized cost basis. As the report explains, an MVRV value of 2 means that the average BTC holder is up by 2x. Meanwhile, an MVRV value of 1 means that investors are breaking even, and an MVRV of 0.85 means that the average investor is 15% down. Currently, Bitcoin's MVRV sits at around 1.2, meaning the average BTC investor is sitting on unrealized gains of roughly 20%. That's a fairly comfortable position for most holders, though historically, extremely high MVRV values have indicated overheated market conditions. For now, though, the report suggests Bitcoin is in a healthy, bullish position without being overly extended. Finally, market activity. Monthly Bitcoin spot and derivative volumes continue to hit jaw-dropping levels, exceeding $2 trillion in June alone. That being said, it's still a far cry from the almost $3.5 trillion volume that we saw back in December after Trump's presidential victory. On top of that, open interest in Bitcoin derivatives, which is the total amount of outstanding derivative contracts held by traders, has also seen a steady increase, reflecting renewed interest and speculation in the market. Now, the next part of the report turns the focus from Bitcoin to Ethereum, crypto's second largest player by market cap, and the go-to proxy for gauging the altcoin market. According to the authors, ETH has seen a remarkable reversal in sentiment, bouncing back significantly from its lows earlier this year. Here, the authors start by highlighting Ethereum ETFs, which experienced a complete 180. After losing around $250 million in Q1, ETH ETFs attracted net inflows of over $1.7 billion in Q2 alone, indicating that institutional money is warming up to Ethereum once again. The report then analyzes investor sentiment for ETH using the Newpol metric. According to the authors, Ethereum's Newpol swung from capitulation in Q1, which is the most bearish sentiment stage, to optimism stages in Q2, which is a relief considering the horrific sentiment around ETH lately. And there's even more good news. The report also covered Ethereum's supply profitability state, and it revealed a stunning recovery. The percent of ETH holders in profit surged substantially from under 40% in Q1 to nearly 90% by the end of Q2. Additionally, at the end of Q1, more than 40 million ETH coins were sitting in a loss, but this figure fell to less than 10 million by the end of Q2. This means that the vast majority of ETH investors are once again sitting on gains. And if you want to know just how big the gains ETH could deliver this cycle might actually be, then check out our video on some of the top ETH price predictions right over there. Anyhow, next, the authors looked at ETH's liquid and illiquid supply. ETH's liquid supply rose by 8% during Q2, while its illiquid supply fell by 6%. Similarly to BTC, this does mean that some long-term ETH holders have been cashing out, using the market strength to sell to newer investors, which also suggests that fresh capital is entering the Ethereum market. The report then takes a brief look at the monthly ETH trading volumes across spot and derivative markets, which, as was the case with BTC, rebounded strongly throughout Q2. In fact, Ethereum's combined spot and derivatives volume rose close to $2.5 trillion in May alone. On top of that, open interest in Ethereum derivatives also experienced noticeable growth during this quarter. As a reminder, open interest refers to the total number of active derivative contracts held by traders, and rising open interest indicates that investors are increasingly betting on ETH's future price movements. Switching gears, the report then takes a closer look at Ethereum's on-chain fundamentals, particularly the activity on Ethereum and its Layer 2s. Ethereum and its L2s saw transaction volumes rise 7% in Q2, despite transaction fees declining by 39%. This dynamic highlights the successful rollout of upgrades like Dencun, which significantly reduced transaction costs and boosted Ethereum's appeal for both developers and users alike. Additionally, the report examines Ethereum's staking trends. By the end of Q2, roughly 35 million ETH were staked, amounting to around $90 billion in value. Notably, despite ETH's volatile price action, total ETH staked continued to rise steadily. However, annual staking yields have continued their steady decline, currently hovering around 3%. While still attractive for long-term holders, it's notably lower than double-digit yields that Ethereum offered back in 2021. This decline in staking yield could pose a challenge in attracting institutional capital that may prefer safer yields like those provided by traditional assets like US Treasuries. And finally, the report notes that Ethereum's total value locked, or TVL, in DeFi continues to remain strong at around $60 billion, which firmly cements Ethereum's role as the biggest chain for DeFi activity by a long way. So then, we've reached the end of this crypto report. But now comes the real question. What does all of this mean for the crypto market? Well, Q2 was clearly a turning point. Bitcoin continued to benefit from increasing institutional adoption, ETF inflows, and growing corporate treasury allocations, reinforcing its position as crypto safe haven. The rapid recovery in investor sentiment further underscores the renewed optimism in Q2, indicating that Bitcoin's upward momentum could well have staying power. And while ETH spent the first part of the year looking like it had lost its mojo, it finally bounced back in a big way, seeing strong institutional inflows and a rapid turnaround in investor sentiment. Sure, the declining staking yields might be slightly concerning for yield-hungry institutions, but Ethereum's Layer 2 scaling improvements and solid fundamentals should support its price in the long run. And as we've pointed out before, historically, where Bitcoin leads, Ethereum and the broader altcoin market eventually follows. And this brings us to perhaps the most bullish factor of them all, macro conditions. The report highlights several key tailwinds supporting crypto right now. Firstly, global trade tensions, most notably Trump's tariff saga, are finally ending, improving overall risk sentiment across markets as investors finally get clarity. Additionally, the Fed is expected to start cutting interest rates soon, injecting further liquidity into the system, which typically benefits crypto. Combine this with significant regulatory progress, such as clearer stablecoin frameworks, and you have a near-perfect macro environment for a renewed crypto rally. Indeed, stablecoin transaction volumes hitting a mind-blowing $4 trillion per month suggest institutions and businesses are increasingly integrating crypto into traditional finance rails. Clear regulations, like the passing of the Genius Act, means that this trend could accelerate even faster. All that being said, however, we should not get ahead of ourselves. Crypto markets are notoriously volatile, and while current market sentiment is bullish, some aspects like leveraged corporate and institutional holdings could trigger forced liquidations if macro conditions unexpectedly deteriorate. Additionally, declining ETH staking yields might slow down new institutional inflows, especially if traditional assets offer better risk-adjusted returns. But on balance, we reckon crypto's future looks increasingly bright. With institutions ramping up exposure, regulatory clarity improving, stablecoins booming, and the Fed poised to pump more liquidity into the system, the stage is set for an exciting second half of the year. And if you want to know how to trade this market, then check out our dedicated video on the topic right over there. And if you haven't subscribed to the channel yet, subscribe to the channel literally right now. Click the button right now. You can do it. I believe in you. And anyway, that's going to do it for me. Thank you so much for watching. I'll see you in the next one. You're awesome. And this is Lewis signing off.